Well, Adrian, a couple of weeks ago, you put out a note asking whether South Africa faced a double-dip recession, and since then we've had a slew of economic data. We've also had the medium-term budget review this week. Is it becoming any clearer to you at this stage?
I think the aspect that I was alluding to in that note was not so much South Africa specifically, but rather the implication that the rest of the world has for South Africa, given the openness of the South African economy to import and export activity, as well as flows of foreign investment. The flows that we're seeing at the moment are really portfolio flows as opposed to real direct investment. And the issue that I was raising was the prospect for the bigger world economies, North America, Western Europe in particular. And at this juncture, I don't think prospects are particularly rosy.
And of course, you talked about the currency and the rand, and we know, of course, trade wars going on at this point. Every country trying to competitively devalue their currencies. Do you think that poses a risk to the recovery, or perhaps something that could push us back into a recession globally?
If you're asking, could a weak rand help exports, or if others weaken their currencies relative to ours, could we lose ground to them? Yeah, I think that is a prospect. The greater risk to South Africa is that the deeper competitive structure of our economy is not being addressed. So whilst if the rand were to weaken, that may have some impact, I think that would be applying Band-Aid to the problem. The deeper issue is addressing South Africa's competitive loss relative to other emerging economies, and in particular I think this resides in the education system. But that's a far longer reaching argument as opposed to the very here and now of are we going to be hurt by a slowdown or another slowdown in the more advanced economies. As things stand, I think that's a real risk.
What's your view then on quantitative easing? Because of course we have the Fed making that decision next week, and it's really unclear how much money could be thrown at the US economy. Do you think they have enough to throw at the economy to keep it afloat?
That's a fascinating problem. The quantitative easing that we've seen so far, my assessment is that it has had almost no impact, and if it has had impact, the impact has been negative. The economy has not done well. The US economy has not done well under that scenario. What we don't have is the counterfactual. What we don't know is what might have happened if there was no quantitative easing. Could we be even worse off? So I think it's all good and well to say, well, quantitative easing has been negative, but we don't know what would have happened if it hadn't been applied. Having said that, I'm not of the view that quantitative easing is going to solve the US problem, or the West European problem, or the Japanese problem for that matter. I think that what will solve those problems ultimately are time. And we've got some evidence of that in the case of Japan, which has now spent the best part of 20 years dealing with a deep balance sheet problem that they built through the course of the 1980s into the early 1990s. The Western Europe and North American scenarios, they've continued, they picked up where the Japanese left off and have built massive balance sheet problems, and they need to address these. No amount of quantitative easing is going to make this go away in a hurry. The only thing that will make this go away is a long-run managed delevering of their balance sheet. It's difficult to know how long that might take, 5 years, 10 years, but it's not years. It's not 1 or 2 years.
Well, where does this all leave the investor, Adrian, and particularly the South African investor? Because you talked about liquidity and money coming into our markets, and of course we've had those portfolio flows into bonds, which have pushed those yields all the way down. Are there opportunities there for South African investors? Where should they be heading?
Well, I think what investors are looking for globally now, the clear sense that I'm getting is global investors are looking for yield. And I was really interested to read recently that in the case of Indonesia, yields on Indonesian government bonds are now sitting just 1% above US government bonds. I'm not sure that US government bonds are that great a barometer for risklessness, but the argument or the evidence that the yield gap between the Indonesian and US bonds is so narrow gives you a clear sense of just how hungry investors are for yield. In the case of South Africa, we can get a 6 or 7% government bond yield and insure that at a cost of 1%. This is a substantial yield premium to more advanced economies. And I think that this, to a large extent, explains why we have seen such strong flows into emerging markets. And as long as this remains the case, we're going to continue to see those flows. So efforts to try and address currency by working on this flow argument, I don't think we have enough ammunition, so we should probably set ourselves up for an environment in which these flows continue to come. Perhaps the rand gets stronger, and until we see a big wobble, investors will remain enamored with bonds, which appear to be giving really good yields in some cases, and apparently at very low risk. My greater concern is that in parts of this bond market, pricing has got very exuberant. I've referred to the Indonesian case. I think US government bonds are wildly overpriced.
How about South African equities? We have the JSE still holding above that 30,000 level. If you go back to the last time when it traded above 30,000, the economy was in a lot firmer standing than it is at the moment. We also had much higher credit demand from the private sector. I mean, is 30,000 justified given the fundamentals at the moment?
I'm not sure I can be an expert or give an expert opinion on the 30,000 specifically. The way that we assess equity market valuation is not to take the most recent year's earnings or next year's earnings, but rather to try and figure out what an economy or a market is capable of generating by its DNA. So what are characteristic earnings or through the cycle earnings, to use the words of financial analysts. And on the basis of through the cycle earnings, if we use South African JSE equity earnings over the last 7 years, on the current multiple, the JSE looks fair value. It is neither very cheap, attractive, nor is it particularly expensive. So I'm going to give a middle of the road answer and say it looks about fair value.
Of course, some sectors overvalued at this stage. So are there some sectors or companies specifically that are undervalued where investors could still find some decent returns?
Yeah, certainly, I agree with your observation. When I say that the JSE is fair valued, what I mean from this is you can expect equity-like returns from the market over the next 3 or 5 years. And equity-like returns are ahead of inflation. So you will receive a real return, or you should receive a real return from the JSE given its current base. In terms of patches of the market that look expensive or cheap, to me there are at least 2 aspects or patches that are particularly pricey. The one is the cash and near cash retailers. So Mr. Price, Massmart, ShopRite really stand out for me as being very expensive. And the other is the more defensive industrials such as the pharmaceuticals and healthcare stocks. What looks particularly cheap in our analysis is the cyclical industries, and in particular building and construction looks very attractive. We've been talking in recent times about some specific building and construction stocks. If you take the case of Aveng, for instance, in the early months of this year, you could buy the company, the entire business, for 12 billion rand. It had 8 billion rand and still has 8 billion rand cash on the balance sheet. That is 4 billion rand that you're paying for the operating assets of the company, and in the last 12 months it generated 3 billion rand of profit before tax. To me, these are really attractive opportunities.
Of course, you're not going to get very much in cash, and particularly with the prospect of interest rates coming down further. How about property? Does property still offer any value, Adrian?
I think so. Property is closely linked to 2 things. The one, the most obvious being the interest rate cycle. And interest rates look like they, if anything, as you point out, are likely to go lower from here. And if once they finish going lower, I think they probably track sideways for some time, barring any unforeseen huge global disruption. So the interest rate environment is very supportive of the property cluster. On top of that, we've got recovering economic growth. You referred earlier to the medium-term budget policy statement and an outlook that says South Africa's environment is improving. That, I think, is a second factor that contributes to an improved outlook for property. So I'm quite sympathetic on having exposure in our portfolios to property.